Hi, this is Scott Murray, and welcome to the Daily Economic Market Shout for Monday, December 5th, 2022. It's great having you with me here today, and we're going to talk about ISM Services. It rose, surprising the market, and we've actually seen a movement higher in interest rates alone today because we saw more activity. Actually, the service reading encompasses several matrix that are not just the activities element. And when we look to that activities element by itself, we see a much better reading, actually moving over 60. Businesses are busy. What are they hearing? They're hearing new orders. They're seeing people looking forward optimistically to 2023. Yes, that's a little different than this very much anticipated recession next year. So businesses, particularly services, and remember that services is the most important part of our economy. It dominates. We can't say that 50 years ago, but we can clearly see that today. And not only does it dominate the economy, it's dominated the inflation debate. We've seen it in housing. We've seen it in Medicare. Medical care, I should say. We've seen a movement higher in prices. These are mostly service related, and they have produced overall inflation elements. And that's really important because, again, we saw in the month of November, the 14th straight month of a reading of the price index over near 70 or above. Now, contrast that to manufacturing. That's actually prices are falling. So we see healthy, even dramatic price gains continuing to plague the service economy. And that's, again, going to be an issue. We're a week and a half away from the Fed's meeting. They are looking to increase interest rates. The market is expecting 50 basis points. What does that mean based on this number? It's probably going to be something they're going to do. There has been talk, even last week from Chair Powell, that we're maybe pulling back a little bit on the hikes. Yeah, 50 basis points is not the 75 we've seen lately, but there is going to continue to be pressure when we see numbers like this, prices increasing at a dramatic rate for an important part of the economy. That's going to put pressure on the Fed and interest rates. Let's dive deeper into the market numbers. We see imports very weak. I'm sorry. We see imports strong. We see exports weak. Let's dive into export orders. That's telling you the global economy is still struggling. So individuals, international businesses are really not demanding a lot from the service economy here in the United States. Contrast that the United States service economy is demanding a lot from the international markets. And so that's telling you that we're trying to heal the supply chains. They're still slowing down. They've been slowing down since the pandemic started. So unlike manufacturing, again, we have not seen a turning the corner in supply chains. So yeah, it's still a problem. It's getting worse as a problem. And that is then moving into prices. How about employment? We're actually seeing good news there. Service companies are hiring. They're filling positions that they've struggled to fill. And so that's, again, I think, going to be a catalyst. It kind of reinforces what we saw on Friday from the jobs market. Inventories seem to be stable. That's a healthy sign for activity moving forward. But the bottom line is new orders solid, activity healthy. And that, I think, is going to set us up for probably a little bit of a surprise, particularly early in 2023 about the strength of the economy. Yeah, we do think the toll of interest rates will hit and will hit next year. But when it hits, it might be pretty modest compared to what the markets are expecting today. This is Scott Murray with the Daily Economic Market Shout. Thank you for joining me.